Welcome to Integro Talks, a podcast series brought to you by Integro Advisers, where we dive into the world of compliance, risk management, and due diligence, and provide you with expert insight and analysis to help you make more informed business decisions. Welcome back to the podcast. I'm your host, Alberto de la Portilla. As many of you know, I'm the CEO and founder of Integro Advisers, a risk management firm based in South Florida. This month, we mark 15 years in business. Given this special milestone, I thought for this month's episode of Integro Talks, we take a look back at how the world of risk management, particularly as it relates to financial crimes, AML compliance, and economic sanctions, has changed and evolved in the last 15 years. And also how these dynamics, as well as market forces, have impacted the bank compliance industry. To take this look back together, I've invited three distinguished guests to join me in the studio today. To my right, Alba Prestamo. Before retiring last year, she served as Chief Risk Officer and Chief Compliance Officer for Banesco USA for 10 years. Prior to that, she worked as Chief Administrative Officer for Gibraltar Bank and other banks in Miami. Gonzalo Sanchez has more than 30 years of experience in compliance risk management, having worked for Citigroup and HSBC. His last role was as head of financial crimes compliance at Banco Popular de Puerto Rico. And finally, Glenda Nunez, who spent 12 years as a regulatory regulator with the FDIC and with the Federal Reserve, and has been providing AML consulting to financial institutions since 2006. So welcome to the podcast.
Thank you.
So let's jump right in and let's actually enter a time machine and go back to 2009. The U.S. was slowly coming back from the global financial collapse of the market that took down Lehman Brothers, Bear Stearns, Washington Mutual. Other household name banks were being folded into larger institutions. Banking regulators such as the FDIC was warning that the number of U.S. institutions at risk of failure had reached an all-time high, a 15-year high. The global financial crisis forced many countries, including the U.S., to issue stimulus packages and begin implementation around the world. Regulatory agencies like FinCEN and the Office of Foreign Assets Control and various state regulators began imposing more stringent requirements and penalties. The financial crisis led to the implementation of more robust AML programs, and globally, the Financial Action Task Force, the global watchdog, updated its AML standards during this period, and many countries began aligning their national regulations with these revised standards to drive improvements in AML practices worldwide. Banks were nervous about their credit exposure vis-a-vis failed mortgages as regulators and capital were focusing more on prioritizing asset quality and capital reserves over AML compliance. Bank secrecy and tax havens were at the forefront of efforts by the U.S. and other nations to pursue tax evaders. We remember the UBS scandal of several years ago. FATCA was introduced in 2010 to recover taxable proceeds that U.S. taxpayers maintained offshore. So I wanted to set the tone for what it was like in 2009 and talk about what has transpired since then in our industry. Let's start first with technology. Obviously, we have artificial intelligence and machine learning over the last few years, but how has innovations and technology impacted the industry in the last 15 years? And I'll just throw this out to the group.
Well, first of all, thank you for your invitation and congratulations for this baby you created.
Thank you.
So, if regarding technology and working for AML, financial crimes and all, I can't resist. The first time I heard about compliance and AML, I was working for Citi in many decades ago. And at that time, to detect potentially suspicious transactions, the technology was statements, account statements, printed account statements, distributed for branch managers to review each one of those transactions and potentially detect suspicious transactions. Moving forward, as we've seen, technology has exploded, right? But I think still, and probably this is one issue to discuss, the huge amount of transactions alerts that financial institutions have to review on a timely manner, document, and report potentially suspicious transactions. Technology has evolved, but I don't think has helped much in that regard. The amount of people, resources, and money devoted to that still is not helping much. And on the other hand, I would say the best SARs you have are those that are detected by humans out there. Right. So you need to review a huge number of alerts to issue a SAR, but then the best SARs, as mentioned, are those that are initiated by humans. So you mentioned artificial intelligence. Hopefully, where we are, artificial intelligence will help reducing that gap.
Right.
I don't know where we are, but I think that's definitely the best hope for the industry to be more effective, to reduce cost, and to devote resources to other aspects of significant risk that are confronted by the institutions.
Alba, you were at your last institution. I remember you began the process of incorporating artificial intelligence to assist with analytics. Can you talk a little bit about that, in the initial impact of that on the institution?
It definitely allows to grow the bank in a more efficient, but being effective. Because I always tell everybody, to be efficient doesn't mean to put at risk the BSA program. And I think that's what sometimes the BSA officer have a difficult time to let go. It's like having a kid and sending them to school. That fear. But the truth of the matter is that all these criminals, they're becoming more savvy every day. People think that they are not smart. Well, they are. They're always ahead of us. And if you don't have a robust automated process, you're going to miss a lot.
Right.
You know, I remember right after what happened in New York that we thought, even regulators, you had to look at every single transaction if it's only 10 cents. Well, that's not real. And I think FinCEN has come to that realization as well. Okay. So to do the right way in the most effective way, you need the technology. Okay. Now, the issue with technology, and one of the biggest issues that I see with banks, is the integrity of the data. If you don't have good data, I don't care how robust your system is, you're going to fail. And that's where I believe a lot of the banks, they need to focus, cleaning up, making sure that you have the right data. But in our case, it was very good.
You have to have a lot of good quality data too, so that the machine learns, right? So there's not a lot of bias in what they're spitting out, and that you can explain, you know, the algorithm. Well, how does this work? Because an examiner comes to you and they ask you, how is this generating all these alerts? You have to understand and be able to explain it. That's a challenge.
And that's not only, it's a challenge, but the regulators are very much aware that there is bias in data dating back many years.
Data integrity is one piece, but the other one is system implementation. I mean, it took ages since the time you identify you need the technology, you contact the technology supplier, but then there are, I would say, conflicts with other priorities within the organization. You as an AML officer want things to happen right away. You sell the expectation, not sell, but present the expectation to the board, to the regulators, and then it takes ages to implement it. And not only that, not always it happens that it's a perfect implementation. There are glitches, there are data management, and that creates not the perfect scenario for AML and the AML officer and the AML program.
As far as artificial intelligence, there's always this fear that machines are going to take over and take over tasks that humans were doing. Do you see that happening today? Do you see that happening in the foreseeable future, where certain tasks that analysts within compliance departments were managing are going to now be handled by machines, smart machines? And do you see this sort of
I don't think it's going to take it over. I don't think it's going to replace it. I think it's going to improve the process. It'll make it faster, but you still have to have that human interaction. That still has to be involved. And as Alba was saying, it's a lot of data. You need to be sure that you have good quality data.
Yeah.
Because, like everything, garbage in, garbage out.
Right.
So,
Right.
Yeah, what we're seeing is that it allows the institution to grow. Back in the old days, let's call it that way, is every time you grew by maybe 10%, you had to increase your department by 20%. Okay. And that was not sustainable. That's the truth. Okay. So it's not that I agree with Glenda. It's not that it's going to replace human 100%, but the growth of the department might slow down because now you have the technology to do a lot of the work, like putting together pivot tables in Excel.
Right.
That's going away.
And also, I think it will help assign your resources better. For example, the AML program, one integral part is to maintain documentation, right? Have your AML program documentation up to date, etc. And one of the challenges is to ensure that new regulations, changes to regulations are updated. I think there's a space for artificial intelligence to help the AML program, the documentation aspect to improve. And then tracking corrective action plans, which when it has happened to all of us, part of the governance of the program is preparing a lot of documentation for the board, for the regulators, etc. Artificial intelligence should help us gathering data, updating programs. Training is another aspect that artificial intelligence will help you develop better contents, targeted contents, etc.
Right. Let's talk about another area that I think there's been some changes, some improvements in terms of regulations. So looking back at 2009 to where we are today, there have been some significant changes in regulations in the U.S. We know AMLA of 2020 and the Corporate Transparency Act, the beneficial ownership rule. Can you talk a little bit about what, how these changes have impacted the industry, whether it's been good or not for our space?
I can tell you, as a regulator, before, CDD has existed. It's now a rule, 2018, and it was became final and implemented. But it was an existing practice. You expected it. The regulators expected it. I went on an exam and I asked one of the account officers, I'd like to see the KYC on this particular group, this relationship. And the account officer responded, KYK? And, that was back then. We're clearly far from that.
Right.
That was many years ago.
Right.
But the identification of beneficial owners, now we have the registry that FinCEN has set up as a result of AMLA, where we have to, submit all the information and now comes the question as to who has access to it. That guidance hasn't been issued yet. Are the banks going to be expected to access it and compare it to what information they already have?
Right.
The AMLA has just changed so much with the priorities, the predicate crimes under AML, bringing cryptocurrency under the umbrella.
Right.
There's just, been so many changes. And even though a lot was already existing practice, like I mentioned, now it's becoming a rule. And
I think what she points out is that if you see the core regulations for an AML program, I would dare to say they are not very sophisticated. They're mirroring good banking practices, plus an additional requirement, which is detect and report. So going back to her example, it has always surprised me when you talked, and you and I have talked about this. It always surprised me when you are talking to a banker, right? Young banker, I have nothing against youth, but a young banker. And you ask, and you are discussing his KYC concepts, right? And the individual pretends to be surprised. Oh, well, I do not understand that. Come on, it's basic good banking practices, right?
Right.
The regulations have not changed a lot in nature. I think there is a clear effort for more transparency, more accountability,
right?
But I gather the big white elephant within those regulations is responsibility and accountability. We have always thought about first line of defense, second line of defense. And I think we all agree that in today's scenario, the accountability for compliance relies, don't ask me why, the real end of the accountability is in the second line of defense, right? I think there's a cultural challenge to ensure that regulations focus more on the first line of defense, which today I think it's kind of blurry.
Yeah, going back to what Glenda was saying on the beneficial owners, it's interesting. I do talk to a lot of foreign banks, okay, as you know.
Yeah.
And it's interesting because sometimes, like, we were saying that we're the toughest of the toughest, which I strongly believe that we are, okay? But you don't have a centralized place to gather this data. And I said, but that doesn't mean that we're not gathering the data, okay? Because for a very long time, bankers were required, even before the CDD, the regulator would ask you that question, and if you didn't have it, you would get in trouble. So it's not like we didn't know who was behind the company. It's that now it's a rule. It's going to be different, more centralized with the government. But that doesn't mean, and that's something that I talk to the foreign banks all the time.
But you see, that's good banking practice.
Right.
If we very traditional good banking practices is, I'm lend you money. And if I'm going to lend you $1, I need to understand what do you do and who's behind you.
Right.
And that the credit culture in the international banking and local banking has that very clear. I need to know who's behind this. And if I start peeling the onion and I see their complex ownership structures, I'm going to dig in to ensure that my risk is well preserved. What happens is when you change subject and say, now we're not talking about credit, we're going to talk about AML. It's kind of, okay, that's not my issue. I need to explain me in much detail what you want. I mean, this is very basic. I think the regulation is helping moving that accountability and strengthening that concept. But it's not a complex concept.
Yeah. Also, you talked about, foreign banks. You would all agree that foreign banks and foreign banking regulations are beginning to mirror U.S. regulations. The FATF has improved substantially its standards, its evaluations of international jurisdictions, and the compliance culture is slowly getting there in places like Latin America. There is more and more buy-in from another generation of compliance officers, executive management teams. There's more buy-in into global compliance, protecting the reputation of the bank. They understand it a little bit more than it was 20 years ago, right? Would you agree?
The biggest driver?
Yeah.
The U.S. banks, we became the regulators of the foreign countries.
Correct.
That's the truth.
True.
All banks in Latin America, they need to have a relationship with the U.S. bank.
Right.
And when we start getting into the de-risking,
yep.
Panama is a good example. Panama, they need the U.S. banks. And from one day to the other, banks are saying, I don't want this headache. So because of the pressure, regulators put the pressure on us, then we put the pressure on those banks.
Right.
And they have a choice that to maintain a relationship with a U.S. bank, I better start looking like a U.S. bank.
That's correct.
Okay? Because obviously, it's like I tell them, look, we have enough with the U.S. regulation. I cannot worry about your regulation. If you're going to process a transaction through my bank, you have to follow my rules. Mm-hmm. So I think that's what has really helped.
Yeah, I agree with you.
And they're more open now.
Yeah.
I have been doing foreign correspondent banking for a very, very, very long time. And I have seen the progress has been really, really good.
I mean, just in the last 15 years, exponential.
Another aspect is that out there in Central America, South America, management in general has become very sophisticated.
Right.
I mean, they don't need to be told what they need to do. Yeah. They are very good at understanding their risks, and they are very well educated, extremely well educated, and they know that the future of their industry, not only banking, has to do with not complying with U.S. law, but identifying risk. And what I think U.S. laws have helped everybody to establish a good method to understand risk, document risk, corporate governance, obviously sharing technology, and correspondent banking has played a key role, because if you don't comply, your doors to the U.S. market is closed.
Right.
So, and that's why regulations in our countries are mirroring that, but just not because of practicality rather than anything.
Just stay on that point. I think let's talk a little bit about, 10 years ago, there was a lot of de-risking of these countries. Large banks in New York, or let's say in international banking centers, were pulling out of the region. And some countries, they would say, we're going to get out of XYZ country, not to pick on any one country. And that had a major impact as well. There was a desperate move by a lot of these institutions to try to find other avenues to get access to the US dollar and get US correspondent accounts. Time has passed, and now we're seeing some of these banks go back. Some of the larger banks go back. I'm sure they have a different risk appetite than they did 15 years ago. I'm sure technology has helped, having the right resources, having years of training on how to manage the risk. But would you agree that there has been this kind of shifting coming back to U.S. banks looking at Latin America a little bit more deliberately as, okay, there are potential clients here, potential relationships, and we can manage the risk? I mean, I'm talking about the larger banks because from South Florida's perspective, there's always been banks that have offered correspondent banking services to Latin America. We know the market extremely well. We speak the same language. But now you're seeing New York, London banks sort of coming back into the region. Would you have seen that
from the de-risking to the re-risking? To the
re-risking is the new term.
Right. So a new term. Right? Yeah. So bring it back.
Yeah.
And I think we have become more partners instead of, we are U.S. and we're going to tell you how to do yours. We have become more partners with other banks and other countries, how we can help each other. It's like, when we went through the 2001 9/11 crisis, we had to go through a learning curve. Okay? And we want the whole world to go through the same learning curve at the same speed. And that's okay. Right. So we have become more partners. And I think that's the reason why more banks are more open. Okay? And I think even my experience with the Latin American banks, they have opened the doors and they're more transparent.
Right.
because they understand that this is a partnership.
Right.
You know?
Yeah, and I think the regulator the U.S. regulator has recognized that the risking by just picking up the phone and closing a bunch of corresponding bank accounts, to start with, is not a good banking practice, number one. And that's why they said, if you want to de-risk, you need to document. This is not just a guy in London picking up the phone and saying, shut down 30 accounts from Latin America just because I don't really understand the risk. But also there is a very important macroeconomic effect. I mean, MSBs, for example, it's my favorite, right? Yeah, the bad guys might have used, and we know they used MSBs to commit the horrendous 9/11, right?
Right.
And it started from there. MSBs are bad. We need to shut them down. But we cannot ignore that MSBs play a very important role. I mean, the huge amount of funds movement from the U.S. to Mexico, et cetera, et cetera. They play a key role. And at the end of the day, banking is risk management. So the risking is introducing a very important factor in risk management and enterprise-wide risk assessment. It's very important. The regulation is putting additional focus on that. So banks need to develop better data management, good technology to support that process. and use it in an intelligent manner. We've seen many, many cases, and probably you can add to that based on your experience, that you have the AML program, they complete the risk assessment annual exercise, but that's a sitting document nobody uses. So, and that information to use your program to be risk-based and focus on the risk, high risk, it's not used. So the new regulation is going to have that. And the risking, I think it's positive because it opens the world and doesn't shut the door to very useful and very well-managed entities that are just discriminated, I would say.
Right. That's unfortunate. And a lot of these entities that were, there were smaller entities, or let's say smaller institutions 15 years ago are now growing. They're growing in their own local countries, and their customers need access to the US dollar. The one who wants to pay the supplier for equipment that he's importing shouldn't have to go to the number one bank in that country. His bank should be able to service that customer. And so, there's a lot more demand for correspondent banking services. And this helps those economies grow, those businesses grow, and it facilitates transactions between these businesses. I want to talk a little bit now about OFAC and sanctions. OFAC has been around for a long time. It was around back in 2009. We've seen in the last 15 years that it continues to be used by the U.S. government as a foreign policy tool. How has OFAC expanded, regardless of who is president? OFAC maintains its mission to protect the U.S. Well, I would say the global financial system from bad actors. We've seen with Russian sanctions. Can you talk a little bit about how the world of OFAC has changed in the international banking space?
Well, as you mentioned, the world is under a lot of pressure at this time.
Right.
There's a lot of financial crime, corruption, sanction evasion. So you've seen a lot of sanctions issued related to Russia, as well as Venezuela, and others. Depending on your customer base, on the bank's customer base, they have to take a look at this and make sure they have the systems in place, that they have the people, that they have good guidance from attorneys. I was at a particular bank where it had a large customer base from Venezuela, and there were several executive orders coming out, general licenses. It was very complex. We were on the phone, having meetings regularly with the attorneys to make sure that we were doing it correctly, because we didn't want to violate the sanctions. And, and I think it was 2017 or 18 that there were like 3 huge executive orders, all the general licenses that you had to understand. We would have meetings and we'd talk about Executive Order 13808, 13827, and somebody said, I feel like a quarterback in a football game, hut. Yeah. It was overwhelming. Yeah. And you wanted to be sure that you had an include list that included things like PDVSA, Bono, state-owned entities, were they 50% owned? It was complex.
Yeah.
And it's still going on. And then you see they're winding down. And Biden tried to soften it a bit to influence the voting, and Maduro didn't comply, and we're back to,
that
so
backfired.
It's difficult. It's a challenge, and it's hard for the banks to comply.
Yeah. No, I think that rather than talking about OFAC in today's world, you need to talk about sanctions.
Yeah, global sanctions.
Because it's in the US, you have Treasury, but you have Commerce, right? Mm-hmm. And they also have their sanctions concept, which at the end of the day, you need to comply. Also, the European Union becoming very active. Also, in Asia, also the Canadian regulator. So you need to, if we look back to when you started with your business, right? You talk about OFAC, but very rarely, and there was something that you need to buy a list, put it in a filter, and that's it. And it'll tell you, Papa. But then it has evolved so much that, for example, I know you've been, when you talk to your clients, you insist on the concept that if you need to be effective because of the complexity, you need to develop your own sanctions program within compliance.
Right.
Because it requires, as you said, so many updates. You need to, the sanctions officer, he or she has to have a specific profile, attitude, right? Very important to have that constant contact with your lawyer, external lawyers, because there's a lot of sophistication. But then also, very important is the whole concept of technology. For example, let me tell you a bit of a war story here, right? In my previous life, we were a mid-sized bank with zero exposure to Russia. We knew we didn't have any exposure to Russia because of our geography, blah, 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 blah. We all knew. It happens that the Russian sanctions start in full speed, and it happens, sheer coincidence, that the regulators come through the door. First thing they ask us is, show me your Russia risk assessment exposure. And the short answer would be, no, we don't have, because we know we don't have, right? Which was the wrong answer. Right. But hopefully we had done our homework. So we took a risk assessment, our sanctions risk assessment. We do blah, blah, blah. My point is that it has exploded. It's a different discipline. Mm-hmm. It's a different culture. You need to be very good at sanctions, but also the process. Mm-hmm. Every time, I don't know how many Russian sanctions updates have occurred in the last 12 months. Right. Every time there's a new update,
it's weekly, I think.
The sanctions officer, he or she has to do a gap analysis. Yeah. Does it impact us? He or she probably has to issue a bulletin. He or she probably has to inform the board of directors, senior management. Yeah. I don't know, give some kind of training to. So it's very complex, and it's here to stay. Last but not least, I'm a true advocate of sanctions. There is an ongoing discussion. Well, sanctions do not serve their purpose, et cetera, et cetera. Mm-hmm. But for example, the Global Magnitsky Act, which I know your firm has been very active, that's a perfect example. It started in Russia, but we see a very recent example where, guess what? A Paraguayan company, tobacco company, has been included in the list. Yeah. Mm-hmm. So they are doomed. Why? Because they're linked to significant corruption cases. So it's here to stay. It's very complex. Companies, and that's the other, and I finish here. Companies have to develop their own sanctions.
Right. It's not just financial institutions.
Exactly.
You have companies, different sectors, U.S. persons, exactly.
Yeah. Exactly. They need to be, if you are in the global trade, if you are importing, exporting, whatever from anywhere, you need to have that talent within your company to know what are the red lines, what to do, etc.
And going back to, 15 years ago, and even before then, sanctions, you added a name. Or the extreme in Cuba, nothing with Cuba, right? But everything has changed. Yeah. Now there are licenses. Mm-hmm. So basically you had to stop. You had to have the ability to stop that wire, refer to a human, ask for documentation. I have gone through. Ask for documentation and make sure that you meet all the requirements, because the license tells you can do this under this condition, A, B, C, D, and E. So that whole process that has gone far and beyond just adding Alba Préstamo to the list has made the whole process more complex. That's one. The other one, Russia, all those countries, they know how to go around the system. Mm-hmm. Yes. They're experts on that. So what do? They add layers and layers and layers to make sure that they can process the transactions. Because I was reading yesterday, getting ready for this, I started doing some review on all the penalties, and a lot of them have to do with Russia, obviously, because what's happening with Ukraine. And when you start reading them, it's they have so many layers to be able to get to, oh yes, this goes to a Russian company.
Right.
That by itself is quite a challenge for banks.
Right. Very complex.
In general. Not only for US, the whole world.
Right. So you're not just looking at activity to and from Russia.
No.
When you're looking at activity, you have to look at other countries like India, China, Turkey. Make sure, because like you said, they're going around it to try to evade the sanctions.
And you mentioned those countries, but it's Russians are not, I know we're talking a lot about Russia, but Russians are active in Latin America. Right. I mean, obviously we know about Venezuela, Nicaragua, friendlier governments, but they're active in Brazil. They're active in Argentina, in Uruguay, in Guatemala,
Panama.
And they're investing in mining and in all these different sectors. It is very complex how embedded Russia and Russian entities and oligarchs are in Latin America. So a bank in Guatemala that's just trying to do its day-to-day compliance has to be aware of transactions. We actually have learned just recently that there are banks in Latin America that they still do kind of, we just run the check. We don't have any issues with OFAC. And then the US bank correspondent says, we've picked up on some activity involving that customer of yours, where that ship ended up in Cuba or where the product came from North Korea. Oh, we weren't aware of that. No, I know, but we are.
We are.
So that's where you talked a little bit earlier about how banks have become the regulator for these foreign financial institutions.
And they're very talented people. And on top of that, you have that the European economy still depends on the Russian gas. So it's funny that we are sanctioning Russia, but we are also buying their gas because we don't have other choice. Right? And on top of that, you have the crypto world, which I have to admit I'm still a bit lost there, but it helps for them to move things around. I mean, the reality is that their economy, whether you talk about it's a war economy or whatever, I don't know exactly where they are, but they have not perished, right? So the sanctions regime has to be there. It cannot concede that, no, it's not working and we are going to eliminate it. It's going to be here for a long time. And something she mentioned, which is another aspect critical of sanctions, is timing. There are very specific regulations. If you detect something, you cannot leave it there for a while, right? So you need to have very good processes, very good MIS, and it goes back to technology. You are going to implement a filter, whatever that is, but it has to be working from day one. The documentation has to be, for example, one perfect example, when the regulators come in, they sample 3 accounts, which is not 3, it can be 30. One of the aspects they ask you is, when this account was open, show me evidence that you verified these names and the beneficial owners against the list. It's not easy to ensure you have that. You usually tell them, yes, I did. But they want to see evidence.
They want support.
To create that documentation support, you have to have very robust system, documentation, maintenance, etc., which is not always easy.
No, the concept of evidence. I always talk to all the banks that I have worked with. Evidence. You cannot tell somebody I did something. No. And that's audit 101, by the way. You cannot tell somebody I did it. Well, show me.
Yeah, show me.
If you don't have the evidence, really did not happen in the eyes of an examiner, auditor, investigator. And that concept sometimes is hard to...
For example, a mid-sized bank, for example, I don't have the data. How many incoming wire transfers or outgoing wire transfer process? Thousands. Citi, the big ones. For each one of those, you need to have the evidence.
Right.
And that requires engineering, and that requires data management, which it's not always easy to implement and maintain, considering that there, in any given bank, there are numerous technology implementation initiatives that have nothing to do with your AML program. They're implementing, I don't know, a teller system, a whatever. And ensuring that you are the priority and that exists is another significant challenge for the AML program. I mean, AML sanctions program.
Right. So we've talked technology, we've talked regulatory changes and sanctions. I want to talk about something that has, on paper, nothing to do with bank compliance, but was a game changer, and that's COVID. So COVID-19, global pandemic, we have seen since then that a lot of financial institutions, a lot of people that are working in risk management and compliance are working remotely. Can you talk a little bit about what sort of impact that's having in your experience on the kind of day-to-day compliance management?
Well, during COVID, it's interesting. I actually worked on site at the banks. There were just skeleton crews that were working. The plus was the parking garages were empty and there was no traffic, but it was very eerie as you were going into work every day.
Yeah.
But this concept of working from home, it has its pros and cons. Of course, you can go to the market during lunch and wash clothes, but that camaraderie, the learning, the training, corroboration, collaborating together, it's just, it's not there.
It's not there anymore.
While you have a lot of Zooms, it's difficult to manage productivity, making sure you're keeping up with what needs to be done, the quality. I focus on the training, that's very important.
I mean, do you think banks today are at more risk because of this remote?
They're more at risk quality-wise.
Right.
Yes, from informational security, because now you're talking about, having to authenticate and, multi-factor authentication, making sure your IT is covered. And, but I do think that where we could sit and talk about an issue and what have you seen, it makes it a little more difficult. Mm-hmm. You don't have somebody sitting next to you in the cube next door or the desk next to you. But by that same token, you're seeing a lot of banks pushing out services to other countries. And now it's not even just at home. Things are being done by outsourced to other countries.
Yeah. I think COVID taught us a lot of things, right? But for example, in my case, again, another war story, okay? As many other banks, yes, we, from one day to another, everybody, boom. First thing about COVID, we all of a sudden started using Outlook, right? From day one, Outlook.
Oh, Outlook, okay.
All of a sudden, we jumped into Outlook and blah, blah, blah. In our case, and kudos to whatever former colleagues are watching this podcast, we were able, on a very, very difficult time, we were able to pull out a number of corrective action items we had in the list that I think nobody would have thought we were able to do it remotely, right? But that has to do with courage, team effort, etc. In general, what I think COVID introduced a malpractice, I would say. If you are a very experienced veteran, you can work from home. It doesn't make sense that you drive for an hour, you sit on a desk, and you do something that you could do remotely. But for younger people, right? And I recall the CEO of my former institution was very keen on that. It's young people need to be part of a team. They need to feel the pressure, which is part of human nature.
Right.
You need to deal with your supervisor, he or she doesn't have a good day. Well, you need to deal with it.
Right.
Your team members are not happy today. You need to deal with it. You need to deal with the pressure. And you need to, very important, you need to capture the essence of the culture.
You need to dress right. You need to dress appropriately, right?
But you need to, we always talk, and I think it's very important for AML, the culture. And the only way you be part of, or you become familiar with the culture, whatever you define that, is by living within the same roof. And that, I think young generations are losing that.
And I'm sure you have lots to say on this topic, but the sort of experiential, learning, learning through experience by being around people. But you probably have something to say on this topic.
I do understand that time has changed, okay? But I think the risk is the loyalty. It's easier for somebody to make the decision, I'm going to move on to some other place, because many times you stay in a place because of working together, okay? Sure. But when that is gone, if I'm working from home, what difference does it make where I go work for Bank A or Bank B?
True.
So all that investment that you had made in training somebody, getting familiar, is at risk.
That's
okay. True. And like in the case of BSA, that many times you need to sit down and let's brainstorm here, because BSA is no black and white. Okay. That to do it via Team or Zoom is not the same.
No.
Okay.
No,
and not only because I'm older, but I'm
older than you.
But even talking to my son, who's young, and his girlfriend, they enjoy going to work. Okay, because they feel that the dynamic is there. It's different. It's different,
right.
And especially when you bring the junior, they need to go through that learning curve, and you don't do that but at the same time, you understand the driving. So that's why I think hybrid is a happy medium. Happy medium.
And I think leadership plays a key role there. I think we've, through our professional lives, we have had the opportunity to participate in great jolly events and great, very difficult events where you watch how senior management is putting their brains together to deal with something, discussions about how to fix an issue, and you need to deal with different aspects of your life. That gives you endurance. And I think working remotely, there are people that work remotely, and I do not believe that. No, I work remotely, but I go and walk my dog at 8:30, you see? And then I chill and relax, and I'm having my coffee, and I'm watching the mountains and the river. And life is tough. You need to feel the pressure. You need to feel yourself. Hoy tengo un día realmente jodido.
Right.
And I need to move through this day. And many people have gone to work and they have, let me put a brief example. Years ago, I was working for a city and I went to Dominican Republic. And I was talking to the woman, wonderful professional. She was the head of risk. She was pregnant. She had a flu. And she had all these piles of files to review. That's endurance, right?
Yeah.
She would have never done this working remotely or blah, blah, blah. So it's part of the culture, right? And I think younger generations are losing that. But it's a different world, different system, and probably it'll be very successful. But since you ask, we shared our
good, and I appreciate that. I want to. We're kind of on the back end of our time together, but I want to do a couple of things. One is to do a little bit more of a lightning round and go over how the pillars, the famous 4 pillars, now 5, of an AML compliance program have changed, if at all. So let's talk first about compliance officer, which is one of the main pillars of an AML program. I know officers in 2009 didn't necessarily have individual responsibility from a legal standpoint. They do now, as far as managing the compliance program. But you've all held that position, 2 of you at least, compliance officer. I'll start with the most recent chief risk officer and chief compliance. I mean, has that position changed in the last 15 years? What
I'm seeing is that we're going through a transition, okay? There's a group that we went through the pain and suffering of 9/11, okay? Right. And regulators taking an extreme. We didn't have a real structure to speak of. So you have that group that little by little, they're retiring. And then you had the new breed that they didn't go through that experience, but they bring the technology side of it. Okay? So it's a transition that we're going through, the experience, but not that friendly with systems and technology. And then this new that doesn't have this experience. So what I'm seeing talking to so many banks is that they're going through a transition.
Right.
Okay? And I think that transition is very critical. Because to be very successful, you need the two of them.
Right.
Once again, I always make it home. Yeah. It's like a parent training your kid to be ready for life.
Right.
But you need that new vision. And the all is to train and give that experience. And that's what I'm seeing. But unfortunately, sometimes the ones that are almost at the end of their professional life, sometimes they're set on their ways,
right,
and they're not too willing to open.
Yeah.
And then this one is saying, "Oh my God, this is an old person." So that's what I'm seeing a lot.
Well, and we talked a little bit earlier about remote. I mean, obviously, those two have to be in the office all the time,
exactly,
and building that trust within themselves. But any other comments on the compliance officer position, how it's evolved?
No, I was just going to mention, going back to the remote, that the new law is talking about that the individuals, the staff that, manage the program, enforce the program, they need to be in the U.S.
Right. Yes. Can you talk a little bit about that just for the audience, just about that law? The law is currently in
FinCEN is asking for comments about it because they are aware that banks are outsourcing to different countries.
Right.
And so which aspect are they referring to? Is it the BSA officer or is it the entire BSA department?
Right.
So that's something that isn't really clear.
Mm-hmm. But they're pushing for the entire staff potentially to be in the U.S.
Or is it the entire staff? Right.
Or at a minimum, the compliance officer.
No clear yet.
It's not clear.
So that's interesting. That's going to have quite an impact on the costs.
Sure. Right. And but the one, I think a significant point about that pillar, the BSA officer, it's not referring, in my view, to one individual. It's the entire organization. Yes. So, for example, the regulation requires to ensure the individual, and I would say individuals have the adequate qualifications, experience, and the examiners, when they go in, they analyze that. In fact, we've seen, which I don't see that applies to other disciplines, very specific, very harsh comments in writing. This individual doesn't have the right qualifications, which means they have to hurt somebody.
Yeah.
And it also has to do with how good is that organization? Do they have the resources? Do they have the amount of money? And also it opens the door to the whole concept of governance. I mean, the relationship between the AML officer and the board.
Right.
The board is ultimately responsible for that, which opens significant challenge for the board. And you and I have discussed about that. Today, you're a board member, and whenever you talk about how good is our AML program, he or she has a challenge. Our favorite example is when they are in the risk committee, right? And they are talking about credit losses. Well, they have some indicators, right? Credit losses, provisions, etc. But when they are talking and they want to really go to bed at night and say, my AML program is working well, what information do they have? A very self-confident AML officer telling them we're doing fine. And all of a sudden you have a subpoena, all of a sudden you have the problem.
Right.
So in that regard, the AML organization and that pillar, I think it has to do a very good job in developing good governance structure,
right,
good open channels with the board.
Yep.
And last but not least, the world is changing so fast. When you created your company, and when we were young, when we started, the AML officer was a lawyer, right? Now I think the AML of the future has to be a good mathematician, a good engineer, and the others, the essential concepts are easy. I mean, come on. It's easy to understand. Implementing, getting the data, and being very well in managing the culture. That's a different profile. Maybe a lawyer has it, but you need to be very good at implementing systems, and understanding the data and drilling down the data. And that is a different profile, definitely.
And Gonzalo, you mentioned, how does a board of director sleep at night? So one of the pillars of an AML program is having a strong independent testing function. Any comments on how independent testing has evolved?
I have one. Sorry, very
briefly.
The independent testing is a critical pillar.
It is a critical pillar.
The internal auditors have to do a better work in ensuring they have the right experience and they understand the risks. And I think AMLA is also addressing that by ensuring that the examiners had a better understanding of the risk.
I agree.
Yeah, they're really pushing the training for the examiners, and also feedback from law enforcement to the banks, which would be, very interesting to see what's happening with all this information I'm submitting to you, and getting more, training through that way.
Yeah.
I wanted to go back to what Gonzalo was saying, but really the culture, is so important, because you could be a terrific AML officer, and if you don't have management's buy-in or the board's buy-in, you're not going to get anywhere.
Right.
And they're just going to demean you. You're not going to be empowered, and you're not going to be able to do what you need to do.
Yeah.
And that's quite a challenge, having the right culture that goes far and beyond just meeting the requirements.
Right.
You have to believe.
Yeah.
Okay. You have to believe what are you doing, what you're doing. And that's when you have the culture. And many times they see BSA as a necessary evil. Okay. But not because I believe in what I'm doing. Once you get to that point, then you have the culture.
I think the compliance officer needs to have a certain stomach for it. You have to be able to fight and defend your position and document it and document that risk. If you don't have that in you, maybe it's not the right position for you, because it's a lot of pressure to be
a very good politician. As they say in Chile, you need to have a lot of...
Agree.
Quickly, just other pillars, policies and procedures. Do you want to talk, Glenda, briefly about risk assessments and how that's evolved in the last 15 years?
Well, risk assessments, they've always been around. They've always been expected since, I want to say, going back to like 2006, I think is when we started first seeing them. And now, they're just making it a rule that you're going to have a risk-focused approach towards your risk assessment, that you're going to look at the priorities that AMLA has issued, that you're going to look at, and this is interesting, your customers, your products, your services, and the geographic distribution, which is the same. That's always been the case. But now they're throwing in what kind of channels you have to open accounts, if it's online now versus the regular brick and mortar where they're coming into the branch. That's a whole new change. What kind of clients are you going to allow to open accounts? What kind of accounts will you allow them to open? Is it just going to be a CD where there's not going to be a lot of movement? Are you going to allow foreigners to open accounts? And if so, are you going to limit the transactions that they can, process? That's important, that aspect.
Right.
And then also intermediaries, where you have now a lot of talk about third-party risks, the vendors that are able to process transactions through the bank. And that's another area, that...
Well, fintechs are...
The fintechs, yes. Yeah. And so you're seeing a lot of consent orders related to that, and a lot of discussion on that.
Yeah.
So incorporating all that into your risk assessment.
Yeah,
and it is an evolving document. It's like you said, it doesn't just sit there. Your risk assessment, it should, if it's working, it would identify gaps where your controls maybe aren't as effective as they need to be in this particular risk. So there is a recommendation, let's do this, A, B, and C. And so once you've done it, you've tracked it, you show it to management, we've got this done, we move on to the next gap that was identified.
Right.
But that's the point of a risk assessment.
In the case of the policy, something that I see very, very common is that it's just copy and paste the regulation.
Right.
Okay. That is not good enough.
Right.
Okay. Because basically the policy is going to dictate is what the board approved, what risk I'm willing to take within the framework. Okay. And what I see, not only here in the United States, I see it in the United States and outside, is your copy and paste the regulation. Okay, it's nice to make reference to the regulation, but it's more than that.
Right.
And I think we have to go through a change that it takes more than just copy and paste the reg.
The last two pillars, training. And we've already talked a little bit about training. Training, I think, is a lot better. I mean, it depends on what institution you are, but I think in general, training needs to be more kind of functional training. It can't be just an off-the-shelf training, right? Program. It needs to be something that's specific to the risk profile of the institution. Do you agree? I mean,
with training, as far as I know, there's a specific regulation where you need to have a training, right? I don't think there are regulations where they say you need to have training for credit. And you can be hit very hard if you don't have a good training program. That's one thing.
Right.
The other aspect with training is that in reality, you are an AML officer, and we've seen, I'm a relationship manager. And in my training assignments, I have training from AML, from regulatory, from blah, blah, blah. So I have a bunch of training, right, that it lacks that granularity and targeted. One of the favorite comments from regulators, it has to be targeted, right? It has to, and it has to be
tailored to your bank, to your risks.
And it has to be derived from the risk assessment. Right. There's where the risk assessment is linked to the training program. You rarely find that. But yes, as you mentioned, there are tremendous opportunities with the numerous channels you have for training, but it should be very tailored to what you expect. For me to teach a teller the components of CTRs and regulatory requirements is probably too much. All you need to teach him or her is how do you detect, when do you need to file, and how you file.
Right.
And don't go into the huge concept of regulation, and this is the regulation, and
Yeah.
I agree. I think sometimes we get into this online training because most of us, we have a checklist mentality. Completed. So regular comes in. You had the training. Yeah, here you have. But I think we're missing the point of why do we train people? And the first thing is to make it.
Point.
Yeah, and further to explain to them the importance of what they're doing. But that's what happened many times. Well, yeah, here you have it. Everybody pass, and that's it. Well, you're giving the same test and the same training for 10 years. They better pass. So I think training needs a little bit of tweaking also.
Yeah.
And very quickly, regulators also make a lot of impact. And that has been a debate where you establish a training and you need to have an exam and have to pass. Regulators lately are very keen on that. Yep. It's not only putting the training to avoid that click, but you need to show me statistics about, did you provide the training? Is there any type of test? And what are the results? 50%, what do you do if they don't pass, etc.?
And training on OFAC as well.
Right.
I mean, actually having the attorneys come in and present the training has been very beneficial, and they give it to not only the staff, but to the board so they can understand the complexities.
Right. And then the last pillar, which if we had this conversation 15 years ago, we'd only be talking about 4, and now we're talking about 5, which is the customer due diligence requirements. Anyone want to just briefly chat about that? That was part of, when did that become the 5th pillar? It was just recently, just in the last 3 or 4 years.
2018. Right. It started 202016, but then it was
May
effective
2018.
May 2018, to be exact.
At what time?
Just with the customer due diligence, in my experience, there's a gap that could be or should be closed. In any given bank where you have commercial relationships, you have the CDD, you have it there, which is in the credit files, right? Credit files have, I would say, 90% of the CDD requirements. However, given the complexity of the processes, you start a different CDD. You see what I mean?
Yeah.
So there is a challenge to close that gap. And most importantly, the human factor, right? The relationship managers should have zero problem in advocating to that, because part of their nature, it's part of the culture to ensure that gap doesn't exist.
So we're at the very end of this. I want to thank you. I just want to finish on kind of a lighter note. I always do with these podcasts, as you know. So typically I ask a music question to my guests, but we're going to do something a little bit different because we're talking about 2009. So yesterday I asked ChatGPT what were some of the biggest stories of 2009, talking about technology and innovation using ChatGPT. So these were some of the top stories of 2009. We had the inauguration of President Barack Obama in January of that year. We had the death of Michael Jackson at the age of 50. If you guys remember Sully Sullenberger, the pilot for U.S. Airways that did the landing at the Hudson because I think there were pigeons or some sort of not birds. I don't know what kind of bird it was. Yeah. Some birds had crashed into the window. Bitcoin was launched in 2009. We talked a little bit earlier about cryptocurrency. Let's talk just kind of more of like a little trivia. So does anyone know what the top grossing movie was in 2009? I did not know this, but it was a movie called Transformers: Revenge of the Fallen. Yes.
Wow.
It grossed over $10 billion that year. The number one movie this year is Inside Out 2, and that's grossed about $5 billion. Top selling car in 2009. Does anyone know?
A Toyota
Camry.
Yeah.
That's right.
Wow.
Spot on. Top selling car in 2024.
Tesla.
Toyota.
The Tesla.
Oh.
Model Y.
Okay,
Good. We got some car experts.
Coming here, I just crossed paths with a Tesla truck.
Oh,
definitely we're doomed.
Yeah. The Cybertruck is a whole nother, yeah. So, top Fortune 500 companies, the top 3 Fortune 500 companies in 2009 were, any guesses? Nope. Any guesses?
Walmart.
Yep.
Any
idea.
oil companies? I'm going to use my cheat sheet. Exxon was number 1 and Chevron. So 2 of the 3 largest oil companies. Today, Walmart still remains. And then the other 2, any guess? You mentioned Apple.
The ChatGPT.
Amazon.
Oh, Amazon.
Can't forget Jeff Bezos' Amazon. And then the last question, I want to finish on music. Who sold the most albums in 2009?
Eminem.
Any guesses? Anyone?
No.
Something's never changed. Taylor Swift.
No.
Taylor Swift sold the most albums in 2009, most ever, except for one gentleman who passed away in 2009. That was Michael Jackson.
But she was how old?
Today, she's still the top selling.
But how old was
she? Was
8 years old?
I don't know.
Or what?
6? So Taylor Swift, some things do never change. So anyway, thank you to this all-star team of guests, Alba, Gonzalo, and Glenda, for being guests today on our podcast. If you like what you heard and or like what you listened to, please subscribe in the link below. I appreciate you joining us once again. And we are done.
Thank
Good
you.
luck.
And congratulations.
Thank you.
Congratulations.
Thank you very much to this all-star team.